we're well aware that banks around the world are facing new regulatory regimes from Dodd-Frank in the US, Basel III in Europe, and other banking regulations. The problem with that is where they intersect, where they overlap, and where there are gaps, and what banks need to do to get their arms around all of this. My guest to talk about that today is George Bolenbacher, head of the regulatory reform practice at Kinetics Trading Solutions. George, thanks for coming by to talk about this important subject. To begin with, I wondered if you could kind of frame out these different pieces of regulation and what we're actually looking at here.
Okay, so there are three sets of regulations regarding margin and capital. Those are probably the most important.
Okay.
The first set is Dodd-Frank, which we sort of know about. It says that for cleared swaps, the clearinghouse sets margin and the regulators approve it. For uncleared swaps, there's a requirement that they have margin, but it's not really definitive.
Right.
The second set of rules is put out by the banking regulators, the Fed, the Office of the Comptroller of the Currency, and the FDIC, and it relates to margin for uncleared swaps for banks only.
Right.
And that rule says that there's a set of counterparties banks have to be cognizant of, and a set of margin rules for each of those sets of counterparties. The most important from our point of view is low-risk financial, and that would be pension funds, endowments, etc. And there is no margin requirement, either initial or variation, for those entities up to a certain risk level.
Okay.
And then there's margin above that risk level. The other major category is non-financial corporations. Doesn't distinguish between high risk and low risk.
Okay.
And it says for those there's no margin requirement at all. Banks may need margin requirement for their own protection, but for the regulators there's no margin.
Okay.
We think that those rules for banks trump the rules of Dodd-Frank, which can have an interesting impact for someone who wants to do an uncleared trade. The third set of rules is the Basel III rules for capital, not margin.
Okay.
And that's put out by the Basel Committee on Banking Regulation, but it's actually enforced by the banking regulators in each country. Same three.
Right.
Fed, OCC, FDIC, they have a proposed rule out on capital. And a couple of things are important about that. One is they don't have the same risk structure for capital that they do for margin.
Right.
It's a little odd.
Yeah.
And the second is that they recognize that clearinghouses incorporate some risk for their members.
Right.
So they have capital rules for clearinghouse exposure as well as for exposure in uncleared transactions.
Okay.
So three sets of rules, approaching it three different ways.
Yeah. Now, the title of our segment here is Dangerous Intersection, and so that leads me to my next question. So if I'm a banker and I'm looking at these three sets of regulations with these different approaches, I mean, what do I do? I mean, you know, in my case, I don't have much hair left to pull out.
Right. So the first thing is to think about it partly from the point of view of the customer.
Okay.
Because customers are concerned about margin. That's become a big topic of discussion. So banks have certain advantages over non-banks in a couple of areas in this, one of which is uncleared swaps. If Dodd-Frank requires non-banks to have a certain level of margin requirement, and the banks regulators require a lesser level of margin, the banks will have an advantage in dealing with those low-risk customers, but they also have a capital charge against those same transactions. So banks are looking at it, if you will, from one viewpoint. Their customers are looking at it from a different viewpoint, and the rules have different requirements or different impacts for those two sets. It'll come together in some distinct advantages for customers if the banks use it properly.
Right. So that kind of leads me to my next question is, so, you know, what's sort of the upshot here? I mean, how do you see this kind of playing out? I mean, as you say, looking at it from the different points of view, when it comes to sort of implementation and whatnot, what's your sense there?
Right. The first thing to understand is it's just a big math problem.
Okay.
It's an optimization mathematics problem. And the banks have to figure out for every possible transaction that they see, what's the margin implication and what's the capital implication of this? Do I have too much exposure to one clearinghouse, so my capital charge there will make it less attractive? Should I move it to another clearinghouse?
Right.
If I can give the customer a better margin structure for an uncleared swap, can I charge that customer a little more to cover the capital requirement that I have, and the customer is still better off?
Right.
So what that means is you need a really fast math formula that will work for every transaction you price, figuring in all these inputs and coming up with your optimal pricing. It'll all come out in the price, but you have to be able to do it almost instantly, because that's the way the market works today.
Right. Okay. Well, certainly there's a lot of technology out there that can be brought to bear to address this question. But I appreciate you coming by and telling us about, kind of laying that out there for us, where these various bank regulations intersect and what banks need to do in the areas of margin and capital requirements, and how they can look at them, banks' point of view versus their customers' point of view. And to George's point, it's really a math problem that we need to figure out. So we've been talking about this dangerous intersection of banking rules, Dodd-Frank, and Basel III. My guest has been George Bolenbacher, head of the regulatory reform practice at Kinetics Trading Solutions. Thanks for watching.